So back in 2020, one company made a decision that started a global financial movement. We're talking about MicroStrategy. They didn't just tweak their treasury playbook, they basically tore it up and wrote a brand new one. And now, that same playbook is being copied by public companies all over the world, from Tokyo to California. So how did one single decision spark a potential revolution in finance? Let's get into it. It all started with this one really powerful metaphor. The CEO, Michael Saylor, looked at his company's $500 million in cash reserves, and he didn't see safety, he saw a liability. He saw a melting ice cube in a world of inflation. And that single shift in perspective, it was the catalyst for one of the most radical corporate treasury strategies we've seen in a long, long time. All right, so here's how we're going to break this down. We'll trace the story through 5 parts. First, we'll look at the core idea behind this whole shift. Then, we'll unpack the financial engine that makes it all work. After that, we'll see how it's spreading across the globe, get a handle on the sheer scale of the ambition, and finally, explore the ultimate vision, a potential blueprint for the future of banking itself.
So let's start with the big idea, the foundation for everything else. This wasn't just about buying a new asset. It was about defining a whole new asset class for the corporate world.
This comes straight from their own company filings. They give this thing a very specific name, digital capital. And you have to notice the framing here. They don't call it cryptocurrency. No. They define it by its core features: a store of value, open source, and, this is the big one, it's totally untethered from any single country's monetary policy. This definition is really the intellectual bedrock for the entire strategy.
This slide just nails the paradigm shift. I mean, think about it. A traditional treasury's goal is basically not to lose money. It's all about managing liquidity with low risk. But this new digital treasury model, it flips that completely on its head. The goal becomes long-term appreciation. It turns the reserve asset itself into a growth engine, not just some holding pen for cash.
Okay, so that's the philosophy. But how does it actually work? I mean, how does a company go about systematically acquiring billions of dollars in a new asset? Well, the answer lies in what they call the financial flywheel.
Think of this as the 4-stroke engine that powers the whole strategy. It's a really fascinating piece of financial engineering. First, they use the market's excitement to sell stock at a premium. Second, they instantly take that cash and turn it into more Bitcoin. And here, in step 3, is where the magic happens. Because they raise the cash at a premium, when they buy the Bitcoin, the amount of Bitcoin backing each existing share actually goes up. Think about that for a second. They issue more stock, but the slice of the Bitcoin pie per share actually gets bigger. This accretive purchase reinforces the stock's premium and lets the whole cycle just spin up all over again.
And he's got a name for it, a cryptoreactor. The name just perfectly captures that self-sustaining nature of the model, right? It's designed to be a kind of perpetual motion machine for accumulating capital, turning market buzz into more of the actual underlying asset.
Now, I know what you're thinking. All this talk of debt and leverage, it must be incredibly risky, right? But here's the really surprising data point. Their leverage ratio is actually way lower than giants like Google or Microsoft. At just 9%, it's near a multi-year low. For any institutional analyst looking at this, that's a critical point. It suggests that even with this super aggressive strategy, the underlying bankruptcy risk is remarkably low.
And a strategy this bold didn't stay siloed for long. The playbook is now going global, and it's creating this fascinating ripple effect as other companies start to copy the model.
And here are just a couple of great examples. Over in Japan, you've got Metaplanet, a publicly traded company that completely pivoted its whole business to follow this model. And here in the US, Semler Scientific, a medical device company of all things, came out and said it was adopting Bitcoin because its digital nature is, quote, preferable to gold. The key thing here is these aren't crypto startups. These are established traditional businesses in totally different sectors, adopting a radical new financial standard for their treasury.
The scale of this trend is getting really significant. More than 5% of the entire supply of Bitcoin is now sitting on the balance sheets of publicly traded companies. This isn't some niche experiment anymore. It's a material chunk of the asset class being absorbed by the corporate world.
So that brings us to the sheer scale of the ambition here. They aren't just accumulating, they have a long-term, systematic plan to grow to a size that could rival major financial institutions.
And the number behind their ambition is just staggering. $84 billion, that's the target. To put that into perspective, that's more than the entire annual economic output of dozens of countries. That's the kind of institutional scale they're shooting for.
So this plan actually started in late 2024 as the 2021 plan. The goal was to raise $42 billion, but they were so successful, so fast, that by the middle of 2025, they just doubled the target to the 42-42 plan. The goal is still the same: use a mix of stocks and debt to fund a relentless pace of Bitcoin accumulation, all while making absolutely sure each round of financing benefits existing shareholders.
And they are making some serious progress. As of July 2025, the plan is already 38% complete. That's almost $24 billion raised from stock sales and another $5 billion from debt. So this isn't some theoretical blueprint. It's a financial engine being built in real time, right out in the open public markets.
But what's the point of all this accumulation? What's the end game here? This brings us to the final and, frankly, the most audacious part of the whole vision. It's not just about becoming a huge treasury company. It's about building a new kind of bank.
A massive pile of a volatile asset. That doesn't really sound like a bank, does it? So what is the ultimate vision? How do you possibly turn this into a stable financial system?
The blueprint is basically a three-stage transformation. You start with the volatile stuff, the digital capital, which is Bitcoin. Then you use some clever financial engineering, specifically over-collateralization, to transform that capital into stable, high-yield digital credit instruments. And finally, you package that digital credit into what they call digital money, a product that looks and feels just like a stable, high-yield bank account for a regular person.
And this digital credit piece is the absolute key to the whole thing. Take their product STRC, or Stretch, as an example. It's basically a special kind of stock designed to be really liquid and pay a regular cash dividend. In essence, it takes the long-term volatile potential of Bitcoin and morphs it into something totally different, a predictable, short-term cash flow. It's built for investors who want yield, not volatility. And this is the final pitch. But it's not to investors. This is a pitch to policymakers and entire nations. The argument goes like this. The very first country to create a regulatory framework for this new model, to let their traditional banks offer these stable, high-yield digital money accounts, will get a massive first-mover advantage and attract trillions in global capital.
Which really brings us to the final question, doesn't it? A single corporate strategy has turned into a global trend, scaled up to institutional size, and now laid out a vision for a whole new financial system. So is this just a niche playbook for a few bold companies, or are we actually watching, in real time, the creation of a blueprint for the banks of the 21st century? That is the multi-trillion-dollar question that strategists and policymakers are now being forced to ask.